Ladies and gents, welcome to another edition of Bondex Talks. We have a very special guest with us today, Dennis 𝐸𝐸. I hope I'm pronouncing that right, with a bit of a
Perfect.
German accent. CEO, founder of Midas, or Midas, depending on my Spanish pronunciation. But it's a platform that makes high-quality investments available to everyone, bringing transparency and accountability through blockchain. Dennis has a strong background in finance with experience at Goldman Sachs and Capital Group, where he saw how the best investment opportunities were often out of the reach of most people. So true. That's one of the greatest capabilities of blockchain is democratization of investment or access to investments. With Midas, he's working to change that by using blockchain to simplify investing and make it more accessible. And as everyone knows, at Bondex, we're shaping the future grounded in on-chain trust and reputation for talent and social. And at the same time, we're seeing firsthand how companies with similar principles like Midas are thriving. Real-world use cases applying blockchain to solve problem set solutions that actually involve the real economy in the real world, not just more speculation, trading, things that, in my opinion, are short-term driven. So together, we're witnessing a revolution reshaping industries across the board. And in this episode, we're going to dive deep into how Midas works, the benefits of tokenized assets, RWAs, one of the hottest topics and trends in the entire industry, and how this approach could change investing forever and in the future. So let's get started. Dennis, welcome. Give us a little intro about yourself. Tell us a little more about Midas.
𝐸𝐸, pleasure being on the show. Thank you for hosting, and thank you for the very kind words. Maybe briefly on myself, born and raised in Germany in a small town in Bavaria. Moved to the UK, to London in 2011. So I've been here for quite a long time. And my background here in London was in traditional financial markets. Like you said, I worked at Goldman Sachs and Capital Group. I have many years investing experiences across different sectors. So I really saw firsthand the best investment products, best advice, and many of my friends and peers that had gone on to have careers in the space. So really been a great opportunity and great pleasure from my perspective. And I was involved in a listing of an asset in the past. So together with my co-founder now, Fabrice Grinder, and I can share a little bit more on his story. We listed a fund on Nasdaq, and that effectively led us to go through the SEC registration process, and we got very familiar what it means to set up a fund, go through a regulatory registration process, but basically get a prospectus approved, and that entity ended up buying close to $200 million at its peak, and that made us familiar with the whole process of buying T-bills effectively. And from that experience, we realized, oh, actually, this is very similar to the entire process when it comes to tokenized assets. Tokenized assets, really, there's quite a lot of work around the regulatory infrastructure. And we effectively decided, okay, we'll start Midas based on the experience that we had previously accumulated. And Midas is really a tokenization platform that makes investment-grade assets available for the open web. So what we're doing effectively, we're simplifying a lot of the backend and put the best possible assets from TradFi, if you will, or even crypto native assets on chain and make them composable in a fully DeFi native experience. And we can go into details of these things. What I mean, super excited to be in the show and very much share your opinion. I think the blockchain has so much potential. Bitcoin just is touching the $100,000 marks, but in my opinion, this is actually not a point to celebrate. Bitcoin is very different from blockchain, very different from crypto assets as a whole, and I still think we're really lacking real-world adoption, and particularly in the space where we're active in stablecoins, yield-bearing stablecoins, investment products with stablecoins. This is really unlocking one of the greatest potentials of the decentralized ledger.
I could not agree with you more. We've only achieved a few product market fits in the industry so far. Store money with Bitcoin, sending other money with stables, and then trading. But actually what RWAs potentially might be provides, and one of the killer use cases that should enable an email type moment that onboarded 1 billion people to the web, is really enabling modern financial age for the digital age. Banks, traditional institutions don't provide that. The piping is actually very, very archaic and obsolete. So you have experience kind of navigating that. But ultimately, what blockchain can provide, which again, crypto is blockchain, but blockchain is much more than crypto, is enabling the long tail trading of absolutely everything in a safe, transparent way. That's why RWAs have such incredible potential for me. And I would love to know the exact genesis of the company. We shared a little bit about the inspiration and the journey there, but like, what was the trigger? What was the history of the company formation? I would love to know. I always like to get a little bit of history on the company.
Yeah, sure. Maybe before we go there, maybe just a couple of topics on tokenization, my opinion that I would touch on. I would probably strongly agree on your statement, but actually would ask to classify that stablecoins are ultimately the biggest RWA in the market today. So Circle USDC or Tether USDT is really, in my opinion, the first wave of tokenized assets. So they have been around for 5-6 years, but it really started having adoption. Apologies for this in the DeFi summer, and really as an next extension, I see the tokenizing of other assets. So this could be savings instruments, and yield-bearing versions of those assets as the next step. Because obviously you had the introduction of money, and then you had banks afterwards, and then over time you had brokerage accounts and stocks and other products. So I see a similar trajectory in the blockchain industry.
I think that's such a good point, that people lose sight of the fact that a few decades ago you couldn't really invest in the market as a retail investor. The Robinhoods of the world were not around, the Coinbases of the world were not around. People didn't have access unless they were an institution, right? So I do agree. Now it's about really the expansion of the tradability of absolutely everything. I mean, when it comes to RWAs, I've seen some interesting projects from wine tokenization. That's an investment asset class. It's quite obscure, that could really benefit from some on-chain verification, transparency. So, in this world in which RWAs take over, what would the future of savings look like for everyone investing?
Yeah. So my thesis on this topic is, first of all, like we said, there's a couple of areas within blockchain that have product market fit. Stablecoins are one of them, and I expect stablecoins to continue to grow much faster. So obviously, we at the moment touching nearly $200 billion worth of stables issued on various blockchains, and that is continuing to grow. Why is it growing? I think number one, you have cross-border remittance use cases that are growing and very exciting. They're really use cases. So go to emerging markets, go to Southeast Asia, go to places in Africa. The dollarization of these places is very important. It adds efficiency to a lot of transactions. So peer-to-peer transactions without middlemen. It's much easier, effectively, to export a stablecoin than for JP Morgan to open a bank branch in various jurisdictions around the world. So that's sort of simplicity. So I see a trend for increasing adoption of stablecoins, and that's partly on those FX or cross-border transaction use cases. But obviously, you touched on some of them as well. Another big driver, and we should not ignore that. Another big driver of stablecoin growth is some of the financial use cases on DeFi that particularly go around rates, basis, leverage. That I agree with you. I think there's too much of it, but it's ultimately also something that not to ignore. And there's some elements of actually some very exciting designs of money markets that really finding peer-to-peer networks at scale with product market fit. So we can touch on those later as well. But ultimately, going back to the thesis, stablecoins are growing. There's different reasons why they grow. FX use cases, the on-chain finance economy is growing, and because of that, I expect there will be more tokenized assets that allow users and people to conventionally hold stablecoins to get different savings and investments products. So one example is we have tokenized T-bills, MT-bill as a product, and that very simply is allows stablecoin holders that today hold US dollars or tokenized US dollars to get exposure to the US Treasury bills. So there's a very simple narrative. So instead of giving away your 4.5% to Tether and Circle, you allow users to access exposure to the US risk rate. Another next step that I see then is more exotic tokenized yield strategies. For example, Basis. Basis is a very large category in crypto, and one of the most profitable and attractive opportunities, and that's we've tokenized that strategy with our product called Basis. But ultimately, I see other products coming there as well. I think there's definitely demand for tokenized stocks, bonds, and other products, and I think it really just grows as the stablecoin adoption grow over time. People want savings and investments products for these stablecoins. I think that is the next step. I think there will be a significant trajectory over the next 5 years. These things are not easy, and they obviously they have a lot of exciting topics to discuss: cross-border regulation, security, and these things, and we're sort of right in the midst of it. So we're excited to dig deeper in those topics.
Absolutely. It's certainly interesting that it's a lot of moving parts to execute the real world use cases that will enable mass adoption. They're not overnight. These financial rails for the future on the internet and this next generation of the internet take time because of all those moving pieces, right? Regulation, security, the technology itself, adoption, go to market. But going outside of that, we do this, I do this with Bondex a lot, in which it's sometimes a little bit complex to explain when you're talking to a non-Web3 native user. So I would put you to the test. If you had to explain to your grandmother, why is tokenization important? How would you explain to your grandma?
Okay, give me 1 second to calibrate this a little bit, because
if you have to dumb it down to a really simple way. This is such a fun exercise. Always if you had to explain to your grandma what tokenization is and why this is important, how would you do it? What would your speech be? Doesn't have to be long.
So yesterday I had dinner in a very popular restaurant in London called Flatiron. Flatiron, you've probably been there yourself. After you've dinner, they give you a voucher to get ice cream for free afterwards. It's a bit of a gimmick or a bit of a marketing incentive. And really what they give you is actually a token. They give you, word by word, they give you a piece, a small metal piece with a logo on and all of it, and you can exchange that for a token when you present it to them. So the word token has been around for a very long time. In fact, Thaler is a German word. This is actually the origin of the word token. And these tokenized or tokens have existed for hundreds of years. So a gold coin was a Thaler, and it was a token hundreds of years ago. So really, we have tokenized assets all of our lives and in histories where we didn't know that. So what tokenization is putting these tokens into electronic form onto the blockchain, and that becomes a lot more complicated. So instead of me carrying around a lot of gold, a lot of tokens, we found a way to put them on the internet, and the internet, the internet that came out in the 90s was very, very good at exchanging text files. The internet was very good at video and images, but the internet of value is much more complex, because you need to have a way to ensure that there's really just one version of this token, and it can't be copied and pasted a million times. And how do you do that? And it's a very, very complicated thing. But effectively, that thing cryptography came in and allowed to find ways to uniquely identify the ownership of certain tokens or certain assets and attribute them to a person or a wallet. And so it's just an address. So really, blockchains are a way to put assets on the internet and verify that only one person owns them, but with this thing called cryptography, and we call it crypto. So really what a blockchain tokenization is just putting something we've done for hundreds of years and putting it onto the internet to make it internet native and internet work and live and work on the internet. So that this whole thing around cryptography is important to really identify it, and make sure that only one person owns one asset, and then we make it public and accessible, and that's a very important thing. So ultimately, the internet doesn't rely just on one entity, and that is the same narrative with blockchain. I pause here. I hope my grandmother would understand this.
I think it's too hard. We're still too hard for grandmas to understand, but for a 40 to 30-year-old that does not have crypto, he would have definitely understood it. Part of the thing we need to do in the crypto industry is really hit the simplicity stick. That's also will help mass adoption. But I like two things that you said, right? Which is assets cannot be copied. If you explain it to an old person, hey, the title of your house, have you heard about those people that get scammed because people say multiple titles to their house? If you put it on the internet with the blockchain, that will never happen. And I loved your ice cream analogy. That was very good as well. But yeah, I think that's always a fun exercise I like to do. Going back to Midas. So, and this now we can stop talking to our grandmas. I would say, how are you guys actually on a technical basis executing putting this institutional grade assets on chain? You can kind of walk us through how you would do with the T-bill, which, by the way, fun fact, that essay from Elon Musk and Chat Tapatia op-ed this week put it down 5 basis points. So it saved the US $200 billion a year for an essay on Doge and everything that's happening. So some really exciting stuff happening on the T-bill side. Sorry,
Yeah.
side little note that I couldn't keep in. But yeah, walk us through, okay, how would you go about actually executing it from a technical point of view?
Perfect. There are multiple layers to this. Let's start first with the technical layer. We effectively use an ERC20 token, which is a standard contract by the open stepping library that represents an asset, and that's the first point. And we have a multi-sig and all of these things to make sure it's secure. But really, in the first level, on technical level, we have an ERC20 token. That's a very simple design. We've chosen this because it's widely adopted, it's safe, secure, and it's composable. And it's a really important point. We'll dig into details later. The second thing is that we start then to think about, okay, what does this token represent as a standard token, and how do I attach rights, be it property rights, investment rights, information rights, or otherwise to this token. And here, the work and the heavy lifting is actually around the regulatory structure. So when you look under the hood of what USDC, USDT is, and they really tokenize travel checks, and they don't really have specific value accrual mechanisms. What we've done is effectively we've built an infrastructure, regulatory infrastructure that allows us to attach certain economic benefits and exposure mechanisms to a token, and effectively tokenize exposure to T-bills. So for example, to make this simple, you invest $100 into T-bill. We effectively issue T-bill, and T-bill, generally because of this regulatory infrastructure, represents exposure to US T-bills and in the back end. We then hedge this position by buying an underlying assets that is within a specified parameter. I can simplify this a little bit more. I realize that I'm talking fairly in the technical details here, but really, we start with the token. We have a regulatory infrastructure. We can go to the details of this. And the third layer is then we have an infrastructure or an SPV that's really an asset vehicle that holds these underlying collateral assets. And you have to make sure this is sound and secure, and this is really around the bankruptcy remote nature of this. So you start with a token, then you invest the underlying funds in the collateral, and then effectively you put the collateral into a separate vehicle. And there's different layers of this. The first layer is the technical layer on the issuance of the token. The second layer is the issuance of the regulatory compliant and regulatory infrastructure that attach economic benefits and economic rights to this token. The third layer is then, okay, keeping the assets secure. That's a very important topic here.
And to follow up on that question, can you now compare that in terms of benefits and how that would be superior to when you have to go buy a treasury bill the traditional way? How is this better? What are the benefits of it?
Yeah, very good point. So if I was to buy a treasury bill today, I would go to my broker account, and then I would instruct the purchase of this. So it's the first complexity in also instructs fees. The broker account goes to the bank. The bank goes to the custodian. The custodian goes to settlement layer. And there's effectively a range of middlemen and financialware that would instruct purchase. And then at some point it arrives to the US Treasury. So effectively that adds delays. So typically in traditional financial markets, there's this thing called T+2, and oftentimes the actual underlying settlement of an asset only occurs a few days after you've met the purchase order. And then that instruct fees. And that's sort of the traditional way and how it works. Here, one click, you send stable coins, you immediately receive T-bill, so instantaneously. It's immediately used, and you don't have to worry about anything else. And that's only the start. So you have a better user experience just by the underlying assets. It's more efficient, more fee efficient, it's faster. But then actually you have a token and you have a representation of this that then has all of the benefits that the blockchain presents. So this token is then composable. You can use it across DeFi venues. You can send it to a friend. You can send it to another wallet that you know. It's not constrained to the confinement of your own broker account. In my own broker account in Web2, my stocks and my bonds stay in this broker account, and I can't do anything with them. And they can increase the fees every year, and they actually do. In our instance, you really just receive a token in your wallet, and you can send it to your next wallet. There's composability, and there's really use cases for this. So one of the very popular use cases here, and it makes a lot of sense also financially, is to use this token as collateral. So you own your 5%, earn your 5% US Treasury rate, And then you might say, okay, I go to a lending market, deposit as collateral, I rely on Euler and Morpho Finance, one of the largest lending markets in this domain. And then you borrow assets against it, and you can effectively retain your T-bill yield, but also maybe get involved in some profit transactions. We can go into details, of course. But there's a difference in terms of the user experience, and there's a big difference around this being an open infrastructure. And this is one of sort of the key things we focus on. We want to make investing as open, transparent, and accessible as the internet. And open is really around being accessible and composable. And it's a very important feature, very hard to do in practice. But for the user, they don't have to worry about the complexity. They really just receive a token. They can do whatever they like with the token.
Killer use case, honestly. Just the value proposition is so strong versus your traditional options. This is what I was talking about. Real world problems, solution problem sets. I think in Web3 sometimes we do too much of being a solution finding problems, right? This is just so clear, and we need more of these. So that's super exciting.
Yeah, maybe to go a little bit earlier in the introduction, we discussed in introduction we discussed sort of our background in traditional financial markets. But in traditional finance, large banks, all of them have access to repo markets. It's a very common product. So a big use case for banks is to engage in repo transactions or money markets. And actually the average person cannot do that with their own Robinhood or Huggies Lansdowne account. It's not possible. It's very, very difficult to do. But here we're building infrastructure that gives you the same underlying or similar exposure as the underlying. You hold T-bills, or you get exposure to T-bills, but then you can go and can if you want to seek further, you can go into a DeFi money market and engagement there. And that's really the exciting thing. I think these things are truly complex and very difficult to do in practice because it requires interconnectivity. So they're hard to build. But over time, you really make high quality financial applications available to everyone. And some people are comfortable to navigate in DeFi. Maybe not that everyone will do it and they don't have to do it. But I think that is only adding more functionality and accessibility for a lot of people.
I think, technology gets time to build and iterations for it to be really used by the masses, right? I always give the example, going back to grandmas. From when I got an iPhone in 2008 to when my grandma was sending me WhatsApp voice notes, it was 15 years, right? So when I see the progress from DeFi summer and how crypto savvy and technology savvy you had to be to actually get some of these capabilities versus the applications that are coming now like Midas to actually give this accessibility in a simple way to the mass. This is what gets me excited about crypto. No matter what the cycle does, I know that there's real builders building really, really great use cases out there. There's always going to be that casino side of things, right?
Yeah.
But this is what I really love. And talking more like again on serious things, right? Like you've done NASDAQ, you've done a trader fund, you've gone through all regulations. Obviously, regulation is finally coming in. Hopefully, in the U.S. post-election, this is what we're going to find, a regulatory framework we can operate with. But I would say Europe, where we're located, right, and the UK, they've actually a bit further ahead. Not a big fan of what the UK has done, but MiCA gives clear guidelines. Whether they're right or wrong, it's irrelevant, right? How are you planning to ensure that compliance with those European securities laws?
Yeah, no, fantastic. Really appreciate the question. So, with these, specifically in this domain, and regulatory clarity is extremely important. That's why we've chosen Germany as a regulatory base and legal jurisdiction, and Europe with MiCA and MiFID as a core base. And the reason for this is that one, it gives regulatory clarity to the issuer, so the company, but also to the user. And I think that's very important because effectively there's an established mechanism around rights that certain token holders have, and that only really gives protection, transparency, and clarity to everyone involved. And I think that's very important. I would say, quick caveat, our product is not available in the US, give a disclaimer here, and to US persons. And of course, we would have loved to do this, but in the US it has been historically very difficult because of regulatory and clarity. And we can go into those details later and what might change. But really, going back to what we do, so we have looked into the regulatory framework that allows us to tokenize assets, and there's a few different options that are available, and we've chosen to do it as a MiFID II security that is effectively giving a very broad addition or options on you to tokenize. So that's really the first layer, and we've done this under the German law for a number of reasons, partly because I'm German and I'm very familiar with the space, partly because have been cases of tokenization as early as 2017. There's a lot of companies that have been doing this in this jurisdiction. There's some great leaders and examples in my view actually in this space, and there's been quite a lot of clarity around what you can do and what you cannot do. So really, when you issue these assets, you have to decide exactly how you want to structure them. We've decided to structure them as MiFID II securities, and then you go through the registration process. So when you issue a security, you cannot issue a token there's a legislation called prospectus, not called prospectus, but it's effectively require you can only offer a security to a certain select people or audience if you have regulatory authorization, and we've obtained it for our products. So we've submitted a base prospectus to the regulator has reviewed it and then have approved it. On that base prospectus, we can issue a certain category of tokens, which includes Basis, T-bill, BTC, and others in the future that we can offer to retail persons. These have to be regulatory compliant products, which they already are, and we have very high quality standards there. But it gives us a lot of flexibility in what we can tokenize and what we can offer to users ultimately. And it's a very important thing. I really can't understate the importance of this, that number one, there's regulatory clarity, but number two, there's also a path to offer this to retail investors, because traditionally, whenever you talk about on-chain assets and tokenized assets, these are only available for accredited investors. And accredited investors, that is a very limiting number of people. So the vast majority of the competitors in this domain, I don't want to highlight anyone specifically, but the vast majority, if not all, they're focused on accredited investors that effectively have $100,000 minimum investment. They have $5 million of net worth assets. That is very limiting. So I've talked about what our ethos is, making investing work like the internet or internet investing. The open is also around, and the accessibility is also around this topic of regulatory compliance, that you can also access these products to retail persons in a select jurisdiction. So that's why we've chosen the European framework for this, and there's obviously a very large market. In fact, Europe is the largest market by number of capital per head and persons after the United States. And if you just assume that the United States cannot issue these products for various different reasons, Europe is actually a very large jurisdiction to do that.
Yeah, people don't realize, I think the US has 350 million people. Europe has about 400 million. The issues were much more fragmented than the United States. Well, they're pretty fragmented. They have issues of their own, right? But, Europe is a massive market. The difference is that, sadly, shrinking versus America growing, but hopefully that's something that amazing innovation led and driven by this country, like what you guys are doing, and this continent, will make us more competitive once again, because there's amazing entrepreneurs and amazing innovation happening here.
Yeah.
And on the regulatory side, it's just needed, right? No one likes regulation. It's not for the Bondex to be listed on the European regulated exchanges of tokens, you have to be MiCA compliant, which means you need a MiCA white paper, and you have to go through the regulation. And no one likes regulation. No one likes red tape. No one likes submitted extra forms and stuff. But you do it because you're buttoned up, and ultimately you understand that the regulator is trying to protect people. And so ultimately, going through those steps makes you a stronger project. It also helps you reflect inward about, really examining the entire company from technicalities. It makes you assess yourself and your strength, and the strength of the value proposition, but the strength also of your security, transparency, everything else, and make you up to standard, so that, again, you are providing access, but you're protecting the people as well. Because I think another thing that crypto sometimes, gets wrong is, a lot of people are left holding bags, and ultimately, regulation, I'm hoping the right frameworks, smart regulation, will prevent some of that. So let's hope that that's the direction that we're heading in. And on the future, so let's say that Midas, I know where this is going. You guys have a fantastic trajectory, and I cannot wait for the next thing. Let's say, what would be the impact to asset tokenizations on traditional finance and those traditional players are offering basically a worse value proposition to users and less accessibility? What happens when you open up these floodgates? What happens to those players? What do you think?
I actually think that it opens a lot of opportunities for banks and traditional finance players as well. And in fact, there's actually quite I would say, you already see JP Morgan is doing a lot of work with Onyx, and onboarded several other banks, and they effectively put a private chain, so blockchain technology, but privately operated with private nodes, on chain and facilitate a similar use case we discussed here actually between banks. So money markets with tokenized assets. And I think that's an interesting proposition, because the very important thing here is that the blockchain can validate and transact these assets 24/7, so around the clock, every 12 seconds a block, or depending on the blockchain and the specification. And JP Morgan could not do that in traditional financial ways. That would be market hours and quite limiting. When you just think about the efficiency gain you can get there is huge. When you can liquidate an asset any time of the day, 24/7, compared to market hours, it vastly improves your efficiency for money markets, for instance. So that's just one example of how some banks can improve the efficiency. Just very simply, when you have transactions that require 10% over collateralization because you can only trade them in market hours, and all of a sudden you can trade them 24/7 every 10 seconds, you can probably bring the loan to values from 90 to 95%, meaning you have significantly less equity deployed in this, and everyone in the transaction is vastly better off. So I think banks are realizing this and working on this. Now, of course, banks working on this is vastly complex. JP Morgan also has a very large retail bank, big banking license, and very stringent regulatory oversight for good reasons. So banks will ultimately not be the first mover in anything there.
Okay.
But they're working on some very exciting propositions there. Another project I would highlight here is actually Société Générale in France. The work they're doing with stablecoins is very interesting. I would encourage the viewers to go into details there. They really see the value of MiCA compliant stablecoins, and the stablecoin is really a phenomenal product for a bank. If I was a bank, would issue stablecoins all day, every day.
And you're bringing such amazing, interesting points, because, well, number one is, do you see yourself as complementary versus competition against those big institutions? But you answered that, right? They're not going to be the first movers. They're too slow moving to do. They do innovation by process versus, crazy people building crazy things and going to market, right?
Yeah.
The second is that compliant stable coins, right? So if a bank, why did you say, if I was a bank, I would be issuing a lot of them are exploring this, issuing their own, as governments, CBDCs, right? Or their own stable coins. But ultimately you want a unit, we have a euro for a reason, right? You don't want a million fragmented stable coins across a continent, right? So I'd love to hear, if you were a bank, why would you be using stable coins all day?
All day, every day. And a stablecoin is ultimately for Société Générale, for some of these larger banks that are active in the space, is ultimately a way to open accounts for anyone who has access to the internet. So it's absolutely incredible. When you just think about the reach you have a French bank, and they have 60 million people in their addressable market, maybe 50 if you think about the people that are working age. And all of a sudden they can open a stable coin, and a stable coin can be adopted by millions of people around the world, certainly in Europe, but also globally within their jurisdiction. And that effectively allows the bank to have a very, very large audience. When you just think about the economics of this, so Tether itself is, I think they crossed $200 billion recently in terms of issuance, which is bizarre. This is a number we just can't imagine how large it is. It's the fifth largest, the seventh largest holder of US government debt. So Tether is just, in terms of size, has become so large.
Yeah.
And even more impressively, in my opinion, is the number of token holders. And I can't remember the statistic top of my head, but I believe it was over 50 million, maybe even over 100 million unique token holders.
Wow.
And when you just think about this, it's wild when you think about it in the context of banks. So this is larger than all European banks combined. This is a very, very large organization. And why is this the case? So what's sort of the driver in this? So the stablecoin, this asset, can be acquired by one of your customers. You go to them and you have the primary market, but the stablecoin is open and transferable in the secondary market. And then so your customer can say, okay, I'll go back to my bank and return the money, or say, oh, hang on, no, I don't. I'll sell it on an exchange. And by this transaction of selling, they effectively have a new customer opening a new bank account with this bank. So it becomes a huge network and a very, very powerful topic. So the distribution is very, very vast. It addresses a very large user base. And then you have users selling these bank accounts to other users effectively. And in the back end, you have a very capital-light model. So it doesn't require any capital other than the capital the user puts in. And Tether alone makes what, $5 to $10 billion per quarter a year on US Treasury bills.
That's what's more impressive, I find, about Tether more than everything. You've just compared it to a traditional bank, right? The most interesting part about Tether is that it makes more money than Goldman Sachs per year with 200 employees. So
Tether has actually 50 employees. 50, yeah. And they very recently, with the change of the CEO, they've changed the strategy a little bit. They're adding a lot more people. But it's crazy few people. So the most profitable company in the world per employee.
Correct. So that's what blows my mind. That if you build something on chain, when you build companies on chain, you really have the capability of building something that generates as much money as Goldman Sachs, that has tens of millions or hundreds of millions of customers around the world, like you've mentioned with the example of the French bank, 15 employees. Like that to me is the mind-blowing. Apart from distribution and everything, and I didn't know it was one of the top holders of American US debt. That's also
and the most important thing to take into account here is that it's very profitable, very vast region. It has this sort of viral growth mechanisms that one user selling the token to another user is basically having other people open accounts with them. But we need to remember the network effects of this. It becomes a very, very, very powerful network. And network effects is one of the most powerful things of the internet, and the most profitable businesses in the world have been built on network effects. And that really drives to the liquidity. So a very large trader today would very comfortably trade Tether on an exchange or decentralized exchange or peer-to-peer, because they know the market is very deep and the price pick is maintained. And it's such a difficult thing to break into. It's very, very hard. So you need effectively millions of dollars of trading volume every day, so that someone that maybe wants to trade $1 million is comfortable trading it. So it really is just, it becomes extremely, extremely powerful. I mean, Tether is the way the business has evolved, intentionally or unintentionally, has become one of the most interesting businesses I've ever come across. I've invested across different industries, different geographies. And there's big debate about OpenAI becoming a $1 trillion business or otherwise, but Tether is truly a phenomenal business from the standpoint of network effects, growth, capital efficiency. Warren Buffett would be all over Twitter, all over Tether all day, every day.
Even though he hates Bitcoin, I'm sure he loves Tether every day.
I think he would love it. I think he would absolutely love it. Yeah.
If only he knew how to use a computer, I'm sure he would find himself on his way there. I massively respect him, but I sometimes get a bit angry about some of his shortcomings with crypto. But at the end of the day, Tether is also, as you said, the biggest example of the potential of RWAs, because that is the biggest, the biggest use case that's achieved product market fit. So going back to Midas, and sorry, I actually need to jump into community questions now. So, but you and me are going to hang out, have a beer, and talk about all of this a little bit offline. But I'd love to have some of this. Okay, so first question from the community. First of all, I'm wondering, how does Midas ensure security of tokenization assets in the RWA panorama?
Perfect. So underlying assets, so collateral assets, are held in a separate SPV, so a separate entity from the parent company. So there's a legal separation, asset separation. And the important thing is that there's a security agent and a data verification agent that has access to the accounts and verifies independently that the eligible collateral assets have been acquired. So in the case of T-bill, only T-bills with a certain maturity or similar funds to contain these assets can be acquired. On a daily rate, this verification agent that is named on our website, Ancora Trust, they're one of the leading entities in this space. They verify that these assets have met the eligible collateral criteria, and then they publish the report independent for us online. It's accessible also on our website, and effectively that ensures that, one, the assets are safe and legally separated from the operating entity of Midas protocol. They're verified, and effectively there's a third party doing this transaction. And by the way, this goes above and beyond the standard that's in industry. Tether has not done this, and has not done this in the entire existence. So as a new player, I think you really make sure that asset security is paramount and first and foremost for this. And this is a very important cause near and dear to my heart.
Right, on to the next one. Would love to know Hamida's opinion on what's the biggest challenge in bridging traditional and finance with blockchain.
So this is a novel thing. Like I said, a lot of projects in crypto, they do a quick TGE event and working on sometimes very speculative use cases. What we're trying to do is very hard. We really try to build very high quality products that are sound, secure, regulatory compliant, but also feel DeFi native from investment position. So there should be the highest quality assets, compliant, but the user should not feel intimidated by this. So what's hard around this is actually that under the hood, there are banks, there are service providers, there are regulatory authorizations, and many of these topics that have to be, and then obviously also the integration to secure smart contracts. All of these things, they're not individually immensely challenging, but as a package of various workflows that have to be done. I think that's really quite challenging. I'm very proud of the team that we've built and the people that are involved in here. Really a huge pleasure of working with everyone in the team. And I think we've managed to build a very high quality tokenization infrastructure to deploy more assets in the future.
Fantastic. And I think we'll take one more question from the community. I've always seen RWA as a corporate resource. Do you all think individual investors could benefit from tokenized RWA? I feel like we've touched on some of these points, but
yeah. I actually would answer this question that the inverse way. So I would actually say that traditional stablecoins are this corporate use case. So in the case of Tether or Circle, they retain 5% the full interest they're earning from UST-BURS. But in the case of RWAs, you're giving this exposure to the underlying treasury yield back to the users and control the users. So RWAs are really an extension of what is already built, Tether and stablecoins conventionally, large, scalable, but you actually give people a better product. You give them the yield that comes from US Treasury bills, the exposure from that underlying, and you also allow them other investment use cases while not giving up with the composability. That's very important. You can transact with this asset just like you can with a traditional stablecoin in certain venues. Then, of course, over time, it takes time to build trust of users. But the important thing is that you start out with some very important killer use cases. We touched on them a little bit. We can go into details later.
Well, actually, we don't have much later, but I think we've covered things far and wide and actually kind of getting to the closing today. What I want to do is I want to know updates from Midas' upcoming initiatives. What should people be excited about? Where can they find you? What can you leave us, our audience here today?
Yeah.
Give us the alpha.
Alpha, right, here you go. Follow us on Twitter and follow me on Twitter. Tomorrow we have an interesting update for users. I think it's one of the most exciting updates actually in the industry. So I would give this a follow. Yeah, I'll send you an article tomorrow.
You better send me the article. All right, fantastic. I mean, this is exciting, guys. Then all eyes on Midas tomorrow.
Thank you very much.
That's a big one, huh? One of the most exciting updates in the.
I think it's going to be very exciting. I think watch the space.
I'm really excited. I better be getting some of that. I look forward to getting the link. And Dennis, I look forward to meeting up in real life and having a chat.
Likewise.
I want to thank all the Bondens, ladies and gentlemen. Thank you for tuning in for another exciting edition of our Bondex Talks. I hope you enjoyed it. Really amazing subject on the transformational potential of RWAs and a pioneer in the industry, one of the biggest players, Midas, who is really changing the landscape and who has a very special announcement tomorrow. So go tune in, follow them. And thank you. This is Bondex, Web3, LinkedIn killer, and the future most trusted social network in the world. Thank you very much, everyone. Have a great day. Have a great week.